Or do you see it back here? Earpiece problems. How's that? Now we're good? I don't think it's enough. Now we're good. Hey guys, JC Perez here, founder of AllStarCharts.com, and welcome back to Pardon the Price Action. I am joined, as always, by Steve Straza, and we're going to get right into it. Tech has been on an epic run, Straza, over the past couple of weeks. Is this rally overextended?
Yeah, so it feels that way, right? Since last week, these things have been screaming higher. You could look at momentum readings. There's a ton of different momentum indicators you could look at. I really like the percentage above the 200-day. And let's just look at the NASDAQ here, this first chart. You remember 2017, JC?
I remember it well.
One of the best years in the history of the stock market? Is that fair?
One of the least volatile years as well.
Right. Right now, the NASDAQ, which was just making new multi-year closing lows the last week of December 28th, this thing registered a new multi-year closing low. Now, it's gone a very far, long way in a short period of time, 30 to 35% rally since late last year. It's more extended now from its 200-day than it was at any time during 16, 17, early 18. That really stands out to me. So I think this thing needs to cool off a little bit. We need some backing and filling here. And now the focus kind of shifts to what is the character of that corrective action? Are we correcting through price or time?
I think it's interesting, the rate of change. We talk about this, when we get these thrusts. There's no magic to one thrust over another. The Zweig thrust, and then this guy has a thrust. Everybody's got a thrust. It's more like, are you seeing just relentless momentum coming into play? And are you seeing it again and again? That tends to happen in early cycle, right? Early cycle. The other argument is that this is a parabolic top, right? Which the indexes certainly don't point to that, but on an individual level, like this Avco, maybe that's an Empire State Building formation. It's possible. Or maybe it just achieved the next target, needs to consolidate before the next leg higher. I would argue it's the latter. Yep. I think this is probably maybe due for some kind of digestion at a perfectly logical area, and then we can go from there.
All right, bad breath. You got bad breath? Does the market have bad breath? It's been bifurcated. Breath has been lackluster at best. What are we seeing from market internals right now?
I think it's time for sector rotation, right? I think that we got the thrust that we're talking about. Like here, we're looking at the NASDAQ percentage of stocks that are overbought. Got something that we hadn't seen in a couple of years. You can also see it in the Russell 3000. Again, a thrust of stocks getting overbought that you hadn't seen in years. When you see that, again, those sorts of characteristics tend to be, those are the things that you see early in cycles, early in bull markets, early in uptrends. And we saw those. So if we're in the camp that that's what those things were, then the logical next progression would be a combination of sector rotation, right? And throughout 2023, you've gotten a ton of relative strength out of technology and communications and growth and discretionary, which were the laggards last year. So if you get that rotation back into the other areas like industrials and some of these cyclicals, you're going to get an expansion in the new 52-week highs list. You're going to get an expansion in the new highs list, which we haven't quite seen since that initial thrust. And we haven't seen an expansion in the new 52-week highs list at all. So that would be the next logical progression if this were in fact a bull market.
Go back to that last chart, right? In Q1, Q2 of 2020, we had some of the most historic breadth thrusts of all time. And this one rivals that. I think it eclipsed the reading from early 2020. In the Russell 3000, I would expect a thrust in the NASDAQ, but to see in the Russell 3000, I think is a lot more important. And then all I'll say is, even the best groups, so flip to, one of these NASDAQ 100 short-term highs charts. As the NASDAQ 100 goes to more, makes incremental new highs, percentage of stocks beneath the surface making new highs continues to decrease. And that's no good. I at least want to see the leaders not showing negative breadth divergences. I think you nailed it, right? Industrials, financials, the value groups really have to pick it up for these breadth metrics to improve.
And if they do, I think that, right, I think the expansion in the new highs list is going to come because of the sector rotation. All right. So, Mr. Straza, how do we correct? If the strongest groups are in need of some sort of digestion, what are the weakest stocks doing? What levels are we looking for as support, right? So here's technology, communications, discretionary is really leading this year. If these correct a well-deserved correction, what happens to these laggards? Does money rotate into them? and you get sort of the closing of the mouth, or these drag the rest of the market lower?
So look how bifurcated we are this year, right? You got the leaders, tech up 30, 35%, and then energy or healthcare down 6 to 10%, right? The performance gap between the winners and the losers is become completely unsustainable, in my opinion. What do we do as technicians, as analysts? We watch the leaders during up legs, and then we refocus on the laggards during corrective phases, right? So when we just talked about how tech or growth or the best stocks are overextended here and deserve a little bit of digestive action. I won't be watching the best stocks as closely as the worst stocks, though, during that corrective phase. I want to see if these worst stocks or the market laggards are going to violate key levels. And I think, the chart here of the Vanguard Extended Market Index, which basically removes the S&P 500 from the total market, right? So you're looking at everything that's not in the S&P 500 here. Those pivot lows, those pre-COVID highs are so important. Those are really the levels. They have to remain.
For me, it's financials and small caps. I think this really encompasses a lot of the risk to the downside. These are the laggards. If these start to break, industrials probably break next, and the leaders ultimately catch down. I mean, that's what that looks like to me. I'm not saying that's what's going to happen. In fact, we've been betting the opposite. We're actually betting that money's rotating into small caps. We haven't seen it yet, but our bets have already been placed, and that money will rotate into industrials. Again, hasn't happened yet, but our bets have already been in place. So I'm betting on that rotation. Let's see if we see it.
And it's a very logical level, right, to put trades on. We just put a trade on the Russell 2000. I know the topic's over, but go to the last chart here. Is there a more important level right now than the Value Line 500?
Yeah, I think financials and small caps.
Healthcare continues to trend lower. What are we seeing from the sector right now? And is it defensive?
Is healthcare defensive? Is it offensive? I think it could swing both ways. I would say, generally speaking, it's less defensive than some of the other sectors out there, like industrials or technology or financials. I think it's, probably leans closer towards the staples and utilities and low volatility stocks of the world. But you can argue they're probably somewhere in the middle. And you could see this range bound market. Remember, healthcare represents 14% of the S&P 500. It's the second largest component. So is this a massive topping formation, or is this just a consolidation within an ongoing uptrend? We know for sure it's a sideways trend. How it resolves is still to be seen, and we're pretty much in the middle. But take a look at healthcare on a relative basis. That's awfully toppy as well. So you're going to need healthcare outperforming, getting back above these levels to even have any kind of conversation about relative strength. And finally, even in medical equipment, which historically trades a lot more with technology than with healthcare, because for all intents and purposes, these medical equipment stocks are like robots. They're technology. So they should trade like technology stocks, and they do. And then more recently, with the strength we've seen in tech, it's come from things like semiconductors and not so much the medical equipment, to the point where the medical equipment ETF, IHI, has sort of been rolling over with healthcare underperforming and technology continuing to make new highs. So they're different. But this is the first time we've seen something like this in a long time.
Yeah, and you make a great point about, is it offensive, is it defensive? You really can't answer that at the sector level. You have to drill in. So I would point to these last two charts here. In healthcare, we have four major subgroups. We have big pharma, we have biotechs, we have healthcare providers, plan providers, and then medical devices. And two of them, medical devices and biotechs, are very growthy. They're very techy. They're very much risk on. The other two are very defensive, your healthcare providers and your big pharma stocks, right? So when you look at slide 30 here, we got the breakout in medical devices like we would expect, right? Just like we're seeing all these tech and growth-based breakouts, but then it failed, right? So we were asking ourselves the question, is medical devices right? Does healthcare, do the healthcare providers play catch up here? Well, now that we're back into this range, I think healthcare providers probably violate these lows here.
All right, under the hood, more and more bullish chart patterns are popping up on our scans these days. Have you noticed? Talk to me about this week's Under the Hood report.
I'm so happy. This is such bull market stuff. I can't remember the last time we had 4 bullish chart setups in Under the Hood. Probably early 2021, if I had.
And what I like about Under the Hood is that it's not long only. It's long and short, for the record, for those who are unaware of this particular scan.
We are happy to short stocks.
Yes.
More and more bullish chart patterns popping up on various scans. This scan's great because it's going to incorporate everything, right? It's not It's sector agnostic. It's market cap agnostic. It's going to bring everything in. It's all the hottest stocks. So I love it. What stands out to me? It's these legacy tech plays keep working. I like my Oracle. Look, the relative trend is perfect here. Getting a breakout to fresh multi-year high.
And then why is it that nerdy accountants love Oracle? Quick. Why is it?
This is the industry leader in general ledger accounting systems. So if you work for like a Fortune 500 company, they're using Oracle. They're not using QuickBooks, right? And it's good.
Nerd alert.
Really good stuff. But no, listen, Oracle's a good stock. This is not your Cisco. It's not your Intel. It's not your IBM. This is a legacy tech stock that keeps it real, keeps making new highs. These are new all-time highs. I like it long above 106.
I like the Palo Alto. Nice base here above 220 if we're long. I like that. Target up near 330. You have 50% of upside, well-defined risk. Software making new highs, which is, you're getting rotation into software and they're kind of like closing out their bottoms. This one's already making new highs. So ton of relative strength here, right?
Yeah, listen, all the scans look this way these days with more and more charts kind of rising to the top. So listen, that's breadth analysis too, isn't it?
All right, word association.
So this is a little game that we like to play. It's called word association. I'm going to throw out a word or a phrase. You're going to tell me the first thing that comes to mind. Short squeeze.
I think resiliency since January. Remember you and I, we came into the year looking for squeezes, in some of these growth stocks, these archy names, growthy names, smalls, mids, not so much the mega caps, but the smalls and the mids, they came in super short. And a lot of these stocks were down 80, 90%. And instead of covering their shorts, these short sellers actually added to their short positions to the point where they came into the year the most short they were those groups of stocks like the Carvanas and whatnot of the world. And just they got squeezed. And as much as we thought that they were vulnerable to squeeze, I didn't think that we'd still be seeing it here. We're entering June tomorrow, and we're still seeing these squeezes. Very powerful. Resiliency is what the word that comes to mind.
Listen, for me, it's bull markets, right? Short squeezes happen in bull markets. Somebody asked us, I think, on the morning show, like, when do short squeezes typically happen? They happen throughout the bull market. Early innings, middle innings, late innings, right? What you want to do is throw these stocks on a watch list together. As one or two or three of them start to move, that's kind of tipping the hat that the whole complex is likely to move. And like something like Carvana, I think it had like a 70% short interest when we were looking into it in the beginning of the year. It's come in, but it's still 50%. That's massive. Let me just throw out some other names on the list. We got Wayfair, MicroStrategy,
What's the short interest in Wayfair?
33%, 5 days to cover. Beyond Meat is 43%, 12 days to cover. Novavax, 40%. Marathon's 40%.
And then just keep in mind, guys, that just because there's super high short interest doesn't mean the stock's going to go up. Doesn't mean we absolutely need to buy it. All it means is that there's an inherent catalyst to send a stock already appreciating much higher, much faster, right? Once it gets going. Because remember, Silvergate was 80% short interest, and that turned out to be a zero. So they were right in that. They were not squeezed. My point is, if they're getting squeezed, they could really, really squeeze depending on how high the short interest and that particular short ratio. So, Straza, let's move on to the 2-minute drill. New lows for commodities. Commodities are vulnerable at current levels. What are you seeing in these charts right now?
Throw up chart 2 here. The Bloomberg Commodity Index is in the top pane. The Thomson Reuters CRB Index is in the middle pane. And then our own custom index, where we're trying to equally weight all of the 33 commodity contracts in our universe, is in the lower pane. So that equal weight index is leading to the downside right now. I think the CRB Index definitely follows. And there's some really key levels that could break in the energy complex.
What is that saying for rates?
Probably, right? Well, we got the triple pane right here. Yeah.
So you think rates are breaking down? You think commodities are right?
Listen, when we look from an intermarket perspective, a lot of things are saying lower rates and have been, and they've been wrong. So how you want to weigh the intermarket ratios that we have for rates that are all saying lower versus European yields or other, developed market yields, which are saying higher, that's a tricky one for me, really.
This is how I think. It's hard for me. Some people are like, oh, JC, I don't care about commodities. I trade good old-fashioned American stocks. Well, that's great and everything, but I think that there's a lot of information, particularly in the bond market. I can't have a conversation about the stock market without talking about how it's going to be impacted by bonds and the direction of rates. And if commodities are essentially driving interest rates, which is one thesis, right? Rates are going to be sensitive to whatever the commodities are doing. That's not that far off. And so far, we've seen a lot of that. Commodities leading the way and the bond market following. So if that is the heads up, right? Because think about it, the CRB index continued to make new highs until last summer. But by then, the equally weighted commodities index had already peaked. So then interest rates continued higher into the fourth quarter of last year. The CRB index was already making lower highs, and the equally weighted commodities index was already saying there's a problem. And now you got the CRB and the equally weighted commodities index both breaking down. Again, it's been a solid leading indicator for rates so far. So I have a hard time believing that rates are going to be skyrocketing in that environment. To me, it's probably leaning towards a buy bond scenario. I'm looking at the IEF. If that can break out above 100, right here it's sitting at 98. I think this chart is the buy bonds chart. For bond bulls out there, I think this is the one. Am I wrong?
Another one would be slide 49, right? Inflation expectations follow interest rates, and they also, look almost identical to the commodity index.
That makes sense. All right. Hot takes, what do you got?
Don't be greedy, okay? When it comes to dividend investing, just stick to that sweet spot, 1 to 2.5%. The average yield in the S&P 500 is about 1.7%. If you're getting 4, 5, 6%, there's something wrong. The market's telling you you might not get that 4, 5, 6%, right? So when it comes to dividend investing, we focus on the growers. We focus on companies that can consistently grow their dividend. And guess what? On that list, you don't see much 5, 6, 7, 8% because it's not sustainable. You see a lot of 1.5%, 2.5%. That's the sweet spot. Stick there. They'll still pay you good, and they'll pay you consistently. That's more important.
I want to give a shout out to William O'Neill, rest in peace, pioneer in our industry. A lot of us can learn a lot from his, writings and his work over many, many years. I wouldn't consider myself, quote unquote, an O'Neill guy to the extreme that a lot of our other friends are certainly O'Neill guys. But, in the same way, Straza, that we look at the Young Aristocrats list, which are stocks that raise their dividends every year, or things like Under the Hood, where we're looking at today, where they're seeing an unusual increase in investor interest and things like that. O'Neill's methodology was looking for, earnings growth, right? And fishing in that pond. It might not be the exact pond that we've built here at All Star Charts, but nevertheless, that framework of thinking, that thought process of why don't we isolate these companies because it's going to increase our chances of success if we're buying those versus any random stock. If they're growing, and you're fishing in better ponds in the same way that if we're buying stocks where their companies are increasing their dividends every year, like obviously the companies must be doing something right. So, it's about fishing in good ponds. So big shout out to William O'Neill and his family.
I got to second that. I couldn't agree more. You know how I feel. He's really the father of fusion analysis for me. And that's really the right way to do it, right? It's a quality filter at the end of the day. Why not narrow your universe down to the highest quality stocks and then go from there?
Yep. Love it. An inspiration. Obviously, we're doing that in different ways and different varieties of what, he did a long time ago. So everybody, thank you so much for watching. Thank you for being here. Make sure to give us a like and hit the subscribe button so that you never miss an update, and follow me at All Star Charts. Make sure to follow Steve at S Straza. Leave a comment below and let us know what you think. See you next week.
Peace.
Adios.